What did Trump, his encounter with COVID, and the US elections have to do with the stock market, the US dollar, and oil prices? Hi, I'm Aditya Nain, and welcome to my podcast on money, investments, and finance. Thanks for stopping by and listen on to find out more. Now, for anybody with an interest in the financial markets, and for those with money in the markets, it's natural to think about the risks of major political events. And nothing focuses the mind of an investor like a looming US presidential election. Now, while any presidential election would have got a lot of attention from the global press, the effect is magnified by Canada's proximity to the US and by the fact that the average Canadian investor is heavily invested in both US stocks and bonds. Of course, there's also the truth that whatever happens in the US has ripple effects on Canada, whether we like that or not. This isn't just any presidential election. Firstly, well, there's Trump, and that fact itself would be enough to magnify any interest and market speculation. And add to that the fact that Trump has tested positive for COVID, and the attention, speculation, and uncertainty naturally increases. So, one term you're sure to hear until the election is over, and possibly after, depending on the outcome, is uncertainty, and how the market detests uncertainty. These days, you can judge the level of uncertainty in the markets on a real time basis, just as you can follow the rise and fall of stock prices. Now, this is done by tracking what's known as the volatility index, or VIX for short, which is a measure of the volatility in the US's most tracked stock index, that's the S&P 500, based on the S&P 500 index options activity. Now, options are a type of derivative financial product, one use of which is to allow traders to take speculative positions on the future direction of various assets or indexes, such as, let's say, a stock or a stock index. Now, as you can see from the chart on the screen right now, the VIX has seen a strong move higher in September and in early October, having reached a high of 30 in the previous month. So to put this in perspective, the long-term average of the VIX is close to 20, which is to say that volatility has been pretty high compared to the historical average, and lending further evidence to the view that the time of the election will see higher volatility and uncertainty. The VIX futures contracts maturing in October, November, December, the months close to the election, have all seen slight upward moves. Now, for more on this, check out an article from the Financial Times that I've linked to in the description. Now, while it's true that the VIX is above its long-term average of 20, which implies that we're probably going to see turbulence in the stock markets, there's nothing normal about this year. And so comparing index levels to that average, historical average, may be slightly pointless. Now, so seen in light of the pandemic, the VIX level may not seem too alarming at all when you notice that it had spiked to 75. Yeah, that's right, 75 during the frightful crash of Feb and March earlier this year. So check out the chart on your screen right now to see how that looks. Keeping this in mind, we shouldn't overplay the significance of short-term movements in such indices. Nonetheless, short-term price shocks are often caused by major events, and there's nothing bigger in terms of a major event than a US presidential election. So don't be surprised if we run into some stock market turbulence in the, let's say, over the next 2 to 4 months. But why do we care about volatility at all? Because it's a sign of uncertainty. And as TV anchors never forget to remind us, markets hate uncertainty. Therefore, with uncertainty comes a risk of behavior. Now, this means that in times of uncertainty or in times of volatility, we could and often do see sell-offs in the stock markets, however short-lived they may be. Now, all this amounts to the following. We may see some selling pressure before, during, and also after the election, depending on how close the race and the results are. However, I don't see this as a reason to panic, since we've only recently seen a drop of about 35% in the S&P 500 earlier this year. In fact, it wouldn't be surprising if any dips are quickly bought into. Now, whether we like it or not, financial markets don't care as much as we may think they do about who actually wins the election. They're much more concerned about the relative stability of the election process, the smooth transfer of power, and rough policy consistency between administrations. So check out the graphic on your screen right now to see how US markets have risen steadily over the years, irrespective of which party happens to be in power. Although the stock market is followed closely by regular investors, the US dollar too gets affected by major events such as a presidential election. And while it's fashionable and also reasonable to predict the long-term decline and fall of the almighty US dollar, the near-term situation may just be the opposite. Because of existing and expected uncertainty in the financial markets, which are increasing and compounded because of Trump's encounter with COVID and questions around the post-election transfer of power. Now, in such circumstances, markets would be expected to take a relatively cautious position by possibly offloading some stocks and some types of bonds in favor of cash and other dollar equivalents. If this were to happen, there could be a temporary, if not sustained, rise in the value of the USD, not least since it's already seen about a 10% drop since the beginning of the pandemic. For some more stats and opinions on the fate of the US dollar, I've linked to an article from the Financial Times in the description. Although the difference in economic policy between Republicans and Democrats, broadly speaking, is not currently wide enough to move markets significantly one way or another when seen from a long-term perspective, the fate of one sector of the economy and one commodity in particular hangs in the balance. Now, this sector is energy and the commodity is oil. So the difference in outlook between the Democrats and Republicans is nowhere more pronounced than in the oil and gas resources or energy space, based on their ideological divergence on on questions of the environment and climate change. Now, under Trump, the US has not only excused itself from the Paris Accord, but has also been emphatically against a pivot away from conventional energy and towards renewables. An interesting article in the Times, again linked to in the description, notes that a Biden victory could push depressed oil prices even lower than their current levels, which is around $40 at the moment. As the chart you can see right now clearly shows, oil is well past its prime. While oil has jumped back from the jaw-dropping negative prices seen earlier this year, a Biden victory could easily push prices back to lower levels. This is because Biden, as the Times article says, pledges to rejoin the Paris climate deal, spend $2 trillion on clean energy, decarbonize American electricity, and electrify swathes of the country's transport sector. In addition, there's the case of patching up with Iran, if that's at all possible, resulting in Iranian oil possibly returning to market, thereby increasing global supply and consequently decreasing prices. That's all for now. Please hit the like button if you found this video useful. Also, don't forget to subscribe and click the bell icon to be notified of future episodes. Thanks a lot.